Hey everyone, this week I'm going to focus on the three major trends shaping the multifamily outlook. Two of the forces are short-term, but the third trend will shape the multifamily market over the next decade. So the first major trend shaping the apartment market is construction. Over the last 5 years, builders have added 2.1 million new apartment units. That increased the multifamily stock by 11.2%. The construction activity has been concentrated, with 50% of the new completions in the Sunbelt metros, and the other half was spread across the rest of the country. Markets like Austin, Charlotte, and Nashville led in percentage inventory growth over the last 5 years. And as a whole, the Sunbelt region experienced a 17.9% gain in apartment stock. Comparatively, over the last 5 years, the inventory gain outside the Sunbelt metros was just 7.8%. But while a supply overhang is creating challenges, the pace of construction is tapering. Multifamily starts peaked in 2022, but have since declined by about 75% from that high. And the number of apartments under construction has fallen by half since the peak set in 2023. The pace of construction is now on par with 2016. As a result, the average vacancy rate in the major Sunbelt metros has leveled off at 6.3% as of the first quarter. Comparatively, the average vacancy rate outside the Sunbelt is 4.1%. So while the wave of new construction created challenges in numerous markets, others haven't faced those headwinds. Markets like the Bay Area, Chicago, and New York have had very little supply growth over the last 5 years. And as a result, these metros sustained relatively low vacancy rates. So the elevated new supply risk for multifamily is a localized, short-term challenge. And that headwind was exacerbated last year by the second short-term trend shaping the multifamily outlook. Over the last year, job creation has fallen significantly. In 2024, the US created an average of 122,000 jobs per month, but last year, the average monthly additions fell to just 9,700. And that slowdown in job creation, together with other headwinds like weak consumer sentiment, have begun to restrain household formation. That, in turn, has weighed on new apartment absorption. And metros that generated the most jobs in the last cycle, predominantly across the Sunbelt, scaled apartment construction to meet the historical hiring-driven domestic in-migration levels. But as the pace of job creation has tapered, household formation and domestic migration to the Sunbelt have slowed. That has resulted in higher vacancy rates and elevated rent concessions in those areas. Nonetheless, apartment demand in markets like Phoenix, Atlanta, and Dallas remains strong. It's just not at the levels experienced in the early 2020s. Now, one other headwind facing apartment demand that I should mention is the slowdown in international immigration to the US. Historically, an average of about 1 million people have immigrated to the US each year. In 2022 and 23, immigration surged above 3 million new residents per year. But in 2025, the total net immigration to the United States is estimated to be just 400,000. And based on the current policy outlook, that number won't increase by much in 2026. So the combination of slowing job creation, weak consumer sentiment, dramatically lower immigration to the US, and slowing household formation will weigh on apartment demand over the short term. But despite the short-term headwinds, there is a third trend that will ultimately play through, and that's a combination of demographics and the high cost of homeownership. Over the last 15 years, the median age of first-time homebuyers has increased from 30 to 40 years old. 15 years ago, the monthly payment on a median-priced home was comparable to the average rent in the US. But today, the monthly payment on a median-priced home is more than $1,100 greater than the average rent, And only about 31% of US households have sufficient income to qualify for a loan on a median-priced house. And as a result, the prospective renter population remains robust. Currently, there are about 78 million people in the US aged between 24 and 40 years old. And in 5 years, that number will be about the same. So while apartment demand has tapered over the last year, that demand has not been lost. It's only been delayed. Recently, the number of young adults living with family has reached an all-time high, exceeding even the pandemic. So once the short-term headwinds abate, this long-term apartment demand driver will reassert and bolster apartment absorption even as construction continues to fall. And the convergence of these trends is a recipe for falling vacancy and strengthening rent growth. That is the long-term trend investors need to contemplate as they keep their eyes on the horizon.